All right, welcome everyone. Today, we're going to dive into one of the absolute cornerstones of corporate finance, the concept of valuation. And look, this isn't just some abstract exercise we do in a classroom. This is the real-world tool that helps leaders tell the difference between a smart, strategic investment and just, well, a blind gamble. It's behind almost every major financial decision a company makes. So let's get into the art and the science of figuring out what something is truly worth. Let's begin. Now, think about this for a second. What is the true value of a future promise? It sounds a little philosophical, doesn't it? Someone promises you a payment, a stream of income that's coming down the road. But what is that actually worth to you, right here, today? This isn't just a thought experiment. For any business leader, this is a multi-million-dollar question they have to answer all the time.
And that's really the key. In the world of business, we can't just rely on a gut feeling or a guess to answer that question. We use math. There's a precise, logical way to take all the uncertainty about the future and boil it down to a solid, defensible number that we can actually use today. This is exactly where the rigor of business mathematics meets the high-stakes world of corporate strategy.
So, here's our game plan for the day. We're going to start by looking at a real-world business case, to get our feet on the ground. Then, we'll break down the core financial idea that makes all of this work. After that, we'll get our hands dirty and walk through the actual step-by-step calculation. We'll also spend some time on the common mistakes, the traps I see students fall into all the time, before we get to our final, data-driven answer. Each part builds on the last, so by the end, you'll have a complete framework for tackling these kinds of problems.
Okay, let's set the stage. I want you to imagine that you're a financial analyst at a big company, and your company is thinking about buying a smaller, really stable business. This target company, it's got a great track record, and it's promising to generate a nice, consistent profit of $5 million a year for the next 10 years.
So your CEO walks over to your desk and asks you this question. Not, what will it be worth over the next decade? No, the question is, what is that whole stream of future profits worth to us, right now, today? Your answer is going to directly impact how much your company is willing to pay. You get it right, you could create incredible value. But if you get it wrong, well, you could be the person who signed off on a massive catastrophic overpayment. No pressure, right? Now, to even begin to answer the CEO's question, we first have to master the single most important concept in all of finance. It's called the time value of money. The idea is actually pretty simple, but its impact is huge. A dollar in your hand today is worth more than the promise of a dollar in the future. So why is that? It all comes down to opportunity cost. A dollar you have today can be invested. You can put it to work, right? It could be earning interest in a savings account, growing in the stock market, or being reinvested into your own business. It grows over time. But that future dollar, it's just sitting out there, offering you nothing until you actually get it. This idea that money has a value that depends on time is the absolute bedrock of all financial valuation.
Okay, so let's look at the money in our case study. The company we're looking at is supposed to make a consistent $5 million a year for 10 years. This pattern, a series of equal payments at regular times over a set period, has a special name in finance. We call it an annuity. And just identifying this is a huge first step, because once we know we're dealing with an annuity, we unlock a whole set of powerful formulas and tools designed for exactly this kind of problem. It takes us from a big, messy question to a solvable equation.
So the time value of money lets us kind of time travel with our calculations. We can look forward into the future and figure out a future value. For instance, we could ask, hey, if I invest $100 today at a 5% return, what's it going to be worth in 5 years? That process is called compounding. But for our CEO's problem, we have to do the opposite. We need to travel backward. From the future to today, we need to calculate the present value. So the question becomes, what's the value today of a promise to get $5 million, say 5 years from now? To figure that out, we do something called discounting. It's basically the reverse of earning interest. We have to systematically shrink the value of that future money to account for the risk and the lost opportunity to invest it over that time. So our job is to calculate the present value of that whole 10-year stream of payments, the annuity.
All right, so we've got our business problem, and we have the core financial theory we need to solve it. So now it's time to go from theory to practice. In this next section, we're going to walk through the exact practical steps a financial analyst would take to nail down the present value of that target company's future earnings.
We can break down this whole valuation process into 3 clear steps. Step 1, we've pretty much already done. Identify the annuity. We know it's $5 million a year for 10 years. Easy enough. Now, step 2, this is where the real thinking happens. This is the most important and, frankly, the hardest part of the whole process. choosing the right discount rate. You have to understand, this isn't just some random interest rate. The discount rate is all about risk and opportunity cost. It starts with what we call the risk-free rate. Think of it as the return you could get on a super safe government bond, and then you add a risk premium on top of that. The riskier the investment, the higher that premium has to be. You're asking, how sure are we that these profits will actually show up? And what other investments could we make with this money that have a similar level of risk? A risky new tech startup needs a much higher discount rate than a stable utility company. So, since our target is a pretty stable business, let's go with a discount rate of 8% for our analysis. And then, finally, step 3 is the calculation itself, where we take that 8% rate and apply it to every single one of those 10 future payments, pull them all back to today's value, and add them up to get one single number.
And this quote just hits the nail on the head. This is exactly why we're doing this. It's not about passing a math test. This calculation is what tells you if a project makes financial sense. It's the gatekeeper. Should we launch this new product? Do we build that new factory? Should we buy this company? The present value calculation gives you the hard data to make that call.
Okay, before we get to the final answer for our case, I want to hit the pause button. As a professor, I have seen students and, even professionals make the same critical mistakes over and over again. Understanding these pitfalls is every bit as important as knowing the formula, because believe me, one tiny mistake in your assumptions can lead to a conclusion that is just disastrously wrong. So let's walk through these. First, the biggest one, using an unrealistic discount rate. It's so tempting to be optimistic, to pick a rate that's too low. But all that does is pump up the present value and make a bad investment look way more attractive than it really is. Second, you can't forget that risk is everything. A stable, predictable company and a high-flying, volatile startup are completely different animals. They have different risks, so they must have different discount rates. It's that simple. Third, you've got to really challenge the stability of that annuity. Is that $5 million a year really a sure thing? What if a new competitor enters the market? What if the economy tanks? You have to stress test that number. And finally, never forget that the number you calculate isn't the final price tag. It's your secret weapon for negotiation. Your calculated PV, that's your walkaway point. It's the absolute maximum you should be willing to pay, and that knowledge gives you incredible power at the negotiating table. Okay, deep breath. We have the theory, we know the pitfalls to avoid. Let's get back to our CEO's question. We've identified our annuity, $5 million a year for 10 years, and we've chosen a reasonable discount rate of 8% to reflect the risk. It is time to deliver the final verdict. So, when we use the standard formula for the present value of an ordinary annuity, we plug in our numbers. With our cash flow, C, at $5 million, our discount rate, R, at 8% or 0.08, and our number of periods, N, at 10 years, the calculation gives us a present value of about $38.5 million. This is your answer for the CEO. This number represents the absolute maximum value of that future income stream to your company today, based on everything we know about risk and time. It becomes the solid, qualitative anchor for your entire acquisition strategy. And this is so important to remember. That $38.5 million isn't the end of a math problem. It's the start of a strategic conversation. This number is what anchors your negotiation. Your team might go in with a lower offer, but you know deep down that this is the absolute ceiling. This number informs your whole financial plan, helping you decide if this acquisition is a better use of capital than, say, building a new factory. It turns a complex, uncertain future into one clear, actionable number you can use today. Which brings us to one last big idea. We've spent this entire session talking about the power of numbers, of data, of calculation, and it is incredibly powerful. But at the end of the day, the math is only as good as the assumptions you put into it. So, I'll leave you with this question to think about. In a world full of spreadsheets and financial models, what's the role of human judgment? When does a great leader know to listen to the numbers, and when do they know to trust their gut when it tells them something the spreadsheet might be missing? Thank you.